Hi, Patrick. You wrote a deep dive report on the real estate sector in the Asia Pacific region. I wanted to start off in China. Local authorities released a number of easing measures to support the housing market over the past few months. Will these easing measures work, and what's the outlook in 2025?
We quantify the impact of the China public sector crisis in various ways, concluding that the housing sales risk could extend further through 2030. China's presold but unbuilt homes are more than Germany's entire housing stock. We calculate the figure of at least 40 million by looking at data for pre-sales from 2015 to the first half of 2024 and matching it against the construction figures. Overall, China's new demand-side stimulus could still fail to boost the developers' liquidity. The city government's acquisition of unsold homes will remain slow, with the persistent sizable inventory further weakening the home prices, particularly in the smaller cities. This, on top of the rescue funding, forethought of ensuring the unfinished homes completion, and set to hamper the home sales recovery. The prolonged crisis could push more real estate investors to look for new opportunities in other markets like Hong Kong, Singapore, and even Australia.
Okay, let's talk about Hong Kong. Home prices have fallen to the lowest level in 8 years. Do you expect any type of recovery next year?
So our analysis shows that Hong Kong home prices could turn the corner in 2025, with mortgage rates possibly falling below the rental yields, supporting a sales recovery for the major developers like Sun Kung Kai Properties with the sizable project pipeline. Recent easing of the mortgage restrictions may encourage some investors to buy multiple units, potentially causing new home sales to increase further in 2025. After falling almost 30% since middle of 2021, Hong Kong housing prices may finally arrest the decline in 2025 to rebound by 5 to 10%. Singapore home prices could rise mildly in 2025 for the same reason. At the same time, Hong Kong top talent pass migration scheme could sustain the leasing demand by drawing more workers to the city. The scheme, which seeks to attract people in highly skilled professions or with strong academic qualifications, was introduced in December 2022. Over 70,000 visa applications have been approved as of the end of first half of 2024.
And lastly, given that central banks have started cutting interest rates, what's your outlook for major REITs in Singapore and Hong Kong in 2025?
In Singapore, major commercial REITs such as Suntec and Keppel REIT, with high leverage and low fixed-rate debt ratios, could lift the distributions under the falling interest rate cycle. The similar situation also applies to Hong Kong. Moreover, some of them like Link REIT could be included in the new Mainland China Hong Kong Stock Connect investment channel. The relatively high dividend of those Hong Kong REITs versus those listed in Mainland China could become a major driver of the southbound investment in the public sector. This may boost the trading liquidity of Hong Kong REITs. Also, the dividend yields could also stay high versus the yields on physical properties in Hong Kong. In terms of the leasing performance, linked with high retail occupancy rate could also underpin the steady rental income to support the dividend.
Patrick, thanks for your insights.